it's Jonathan Summer, and I'm just giving you an update on the way things are in the market. And I'm out here in beautiful Caledonia. It's a beautiful sun-shining day with about 3 degrees this morning, warming up to about 10 degrees now. Okay, so let's get started here. First thing I want to talk about is the stress test rules. Now, we talked about stress test rules last year about this time, when they were introduced for people with less than 20% down, or insured mortgages. As of October 21, 2017, the Office of the Superintendent of the Financial Institutions, or OFSI, issued new guidelines for mortgage lending, which will affect low-risk borrowers, or those with 20% or more down payment on a property. And this may affect the real estate market in 2018. So what do we know so far? The guidelines, or stress test, require that low-risk buyers borrowing from a federally regulated financial institution, a bank, a trust company, insurance companies, etc., must be able to qualify for payments of the mortgage at interest rates that are the greater of 2% higher than the actual amount of their mortgage, so the mortgage that they negotiate, whatever that is, 2% higher, or the 5-year posted Bank of Canada rate. So whichever of those two is higher, that's what they will be stress tested out. These guidelines come into effect in January 2018, the 1st of January. The effect will be that buyers will be qualified for a lower mortgage amount than they would have been, which will mean they will have less money with which to purchase a new home. The new stress test rules will apply to mortgage renewals if the borrower moves to a different financial institution. However, if the borrower remains with the same financial institution, their stress test will not apply, provided there are no changes to the existing terms of the loan. New limits are also placed on co-lending and bundled mortgages so that lenders aren't able to get around these new guidelines. Once consumers are aware of the impact of their new guidelines, it is expected there will be an uptick in sales in November and December, with a corresponding lull after January 1, 2018. Now, let's be clear here. Stress testing is actually a good thing. It prevents things like we had in the crash of 2008 in the States. That was a much bigger deal, and people were walking away from their houses because banks had been lending much more than people were actually able to sustain. So when we have stress testing, it ensures that even if the mortgage rates do go up, then people will still be able to afford their mortgages, and therefore they will be able to keep paying their mortgages and stay with their houses. And we won't have this crazy foreclosure and power of sale business that was going on. It's currently unclear how agreements of purchase and sale signed before January 1, 2018 will be affected, and if the stress test will affect previous pre-approvals issued by financial institutions. Provincially regulated credit unions and private lenders are not required to apply the stress test to borrowers if they are uninsured, and it's unclear if they will adopt the same practices or not. There is some question as to whether lengthening the amortization period will help offset the effect of the stress test, and if subsequent guidelines from OFSI might address this option. There's a bit of a loophole right now where if you lengthen the amortization period to 30 years or 35 years, you're able to reduce mortgage payments, and therefore the stress test will be lower, and they'll qualify for a higher amount. The Real Estate Association of Hamilton-Burlington is the organization that regulates the local real estate trading in Hamilton and Burlington, and they have taken a position on this, saying these rules were intended to cool the market and ensure banks and borrowers were not overextended when interest rates rose. However, the local market has experienced a slowdown since the summer, resulting in a more balanced market. These measures may unintentionally, but not necessarily, tip the market further. Let me just offer my opinion on this. We're currently experiencing market conditions where we have approximately 2.5 to 3 months of inventory. Now, a balanced market is where you have approximately 5 to 6 months inventory. So the conditions are still highly favorable towards sellers. The inventory is measured by if no one else listed their houses from this point forward, the inventory is how long it would take to sell all the houses that are currently listed. Earlier this year, we had less than 1 month of inventory. That means that if nobody else listed houses, within 1 month, all the houses on the market would be sold. We're currently at about 3 months inventory, 2.5 to 3 months. And this is generally viewed as a positive thing by most real estate professionals. It means that we have much less competition, and this is more conducive to achieving market value in properties where one buyer, one seller agrees to a value that they can purchase the property at or sell the property for. If you would like more information on any of this, please feel free to call me at my number listed below, or text me or email me. I would love to give you more information on this or any other topic related to real estate. Until next time, have a good day.